Today, we're breaking down SETH, the ProShares Short Ether Strategy ETF, a highly specialized ETF designed for investors who want inverse or short exposure to Ether. This is not a buy and hold crypto ETF, and it is not designed to track Ether over long periods. Instead, SETH is built as a short-term trading tool for expressing a bearish view on Ether's price. SETH tracks the inverse, or -1 times, daily performance of its underlying index. If Ether declines by 1% in a single day, SETH aims to rise by roughly 1% for that day before fees and expenses. If Ether rises, SETH is expected to fall. The key point here is that the fund targets inverse performance on a daily basis, not over longer holding periods. SETH is notable because it is the first ETF to provide inverse exposure to Ether. Rather than holding Ether directly, the fund gains its exposure primarily through standardized, cash-settled Ether futures contracts traded in regulated markets. This structure allows investors to express a short Ether view through an ET without directly trading crypto or futures themselves. The reference price for Ether comes from the Bloomberg Ethereum Crypto Fixing Rate, or CFX, which is a composite price based on US dollar Ether trading activity across multiple digital asset trading platforms. Using a composite benchmark helps reduce the impact of pricing distortions or liquidity issues that can occur on individual exchanges. To maintain its inverse exposure, SETH resets its futures positions daily. This daily reset is one of the most important concepts to understand. Because of compounding effects, the fund's returns can vary significantly from -1 times Ether's performance when held for more than a single day. In volatile markets, even if Ether ends a period lower, SETH can underperform expectations due to the path prices take along the way. For this reason, SETH is not designed to be a long-term investment vehicle. It is best used as a tactical instrument for short-term trades, hedging existing Ether exposure, or positioning around specific events that may impact crypto markets. Holding SETH for extended periods without active management can lead to unexpected results. Another structural detail investors should be aware of is that SETH gains its exposure through a wholly owned Cayman Islands subsidiary. This is a common structure used by futures-based commodity and crypto ETFs to manage futures exposure efficiently while meeting U.S. regulatory requirements. It's also worth noting the fund's index history. Prior to March 15, 2024, SETH tracked the S&P CME Ether Futures Index, and until September 27, 2024, it tracked the Bloomberg Galaxy Ethereum Index. These changes reflect the evolving nature of crypto benchmarks as liquidity, transparency, and market structure continue to develop. The bottom line is this: SETH is a short-term inverse Ether ETF designed for tactical use, not long-term investing. It can be an effective tool for experienced investors who understand inverse ETFs, daily resets, and futures-based exposure, but it requires close monitoring and disciplined risk management. If you found this breakdown helpful, make sure to like the video, subscribe to the ETF Investor, and comment below. Do you ever use inverse ETFs for short-term trades, or do you prefer to stay away from them entirely?